Good day. Today we are going to focus on the final accounts. Okay, so the final accounts are used by the business in order to calculate the profit at the end of the financial year. So meaning that when the business wants to calculate the net profit or the profit, the business uses these two accounts. The first one is called the trading account. The trading account is used to calculate the gross profit. And then the profits and loss, it is used to calculate the net profit. Okay, now let's look at this. So the gross profit, how do we get the gross profit? The gross profit is equal to sales minus the cost of sales. That is how you get the gross profit. It is the sales minus the cost of sales. And then we have the net profit. Net profit, it is equal to gross profit, okay, plus the incomes minus the expenses. Then you get the net profit. Okay, but then let's look at the trading account. How is it prepared? How is a trading account prepared? So this is a trading account. So we have the debit side and the credit side. So when you are preparing a trading account, on the debit side, remember, this is done at the end of the year. Okay, this is done at the end of the year, meaning that for the date, you must write the end of the year date. Okay, so it is going to depend that your financial year ends when. So we are going to write it here. Okay, so on the debit side, you must record the cost of sales. So the cost of sales, they will be provided in the trial balance. Okay, the cost of sales will be provided in the trial balance. And then you will go to the adjustments. Okay, and then you will check whether there are any transactions that are affecting the sales. I mean, that are affecting the cost of sales. So if there is a transaction in the adjustment that is affecting the cost of sales, it will mean that you will come here to the cost of sales and open the bracket, and then you're going to start with the amount that is given in the trial balance, and then you will then record the one that is in the adjustment. Now, how do you record that one? Now, it is going to depend on whether that adjustment, it is saying that there were goods that were sold and then they were not recorded. So if goods are sold, what is happening to the cost of sales? The cost of sales must increase. But then if it is saying that the debtor has returned the goods, so it means that you will have to come here and decrease the cost of sales if that is written in the adjustment. Okay, you will close the bracket and then you come and write the amount here. Okay, and then you come to the credit side. So you write the date and then you must record here the sales. Okay, you must record here the sales. So you open the bracket, you will take the sales that are given in the trial balance, and then you will subtract the debtors allowances. Subtract the debtors allowances. Okay, and then again you will also go to the adjustments. You check whether there's a transaction that says that or you check whether there is a transaction that is affecting the sales. For example, if there were goods that were sold and then it was not recorded, so you will have to come here in the sales and then record it. So if there were goods that were sold and it was not recorded, it will mean that you will have to come here and increase the sales. But then if it is saying that there were some goods that were returned by the debtors, it will mean that the debtor's allowances are affected. The debtor's allowances are affected. Remember, when the debtors return the goods, the sales are not affected. It is the debtor's allowances that are affected. But you know that the debtor's allowances, they decreases your sales. So meaning that you will also come here and decrease. Remember, only if it is there in the adjustment. Then you close the bracket, then you write the total here. Okay? And then now you will check. You will check which side is bigger. Okay? Which side is bigger? So if the credit side is bigger, so it will mean that you will balance both sides with the bigger side. So balance both sides with the bigger side. And then so the bigger side is the credit side, and then you will have to get the difference between the credit side and the debit side. And then that difference, it must be transferred to the profit and loss account. So it must be transferred to the profit and loss account. So the next one after this one is the profit and loss. So this is a profit and loss. Profit and loss. So remember, we said that we must transfer this amount to the profit and loss. It is coming from where? It is coming from the trading account. Okay, so you write the end of the year date here. Okay, and then now in the profit and loss account, this is debit, this is credit. In the profit and loss account, so on the debit side, you must write all the expenses. For example, if there's a rent expense, you record it here on the debit side. If there's insurance, you record it here on the debit side. So you record all the expenses on the debit side. And then also on the credit side, you must record all the incomes. So it can be the rent income, it can be the discount received. So you record all the incomes on the credit side. And then after that, you check which side is bigger. So if the credit side is bigger, it means that the business made a profit. So we have to come here, you balance both sides with the bigger sides. So if the bigger side is the credit side, you will balance both sides, right? And then you check it is big by how much. So you check the difference. And then you're going to have the capital. So that you are going to have the net profit. This is the profit. So that difference is called the profit. Remember, I said that the profit and loss is used to determine the net profit. So now, if the debit side is bigger, it will mean that this is going to be here on the credit side, but then now it is going to be a loss profit. This is a loss. It is no longer a profit, it is now a loss if the debit side is bigger. But then I'm going to do the example in the next video.